Let's get some insights on the market. All the news that we've been seeing. David Grumhaus is with us, President and CIO at Duff & Phelps Investment Management. Some of your thoughts here today. I know the major averages are not far off the unchanged line, but we have been bumping up against records, but have had some volatility as well. What do you make of the next few weeks of the market going forward?
Sure, it's certainly been good to be with you this morning, but it's certainly been a impressive market, impressive first half, and July's been incredibly strong. And I think a couple things are happening there. One is you've got seasonality working for you in July. July is always a good month historically, and that's certainly proven out. And then I think you've gotten some real certainty come out here over the last couple of weeks on two fronts. One is the Fed, certainly with the most recent CPI report, as well as with recent Fed speak, the September cuts look highly likely. And then secondly, obviously around the election, I think the certainty there, the market really likes the likelihood of a Trump election, and even a Republican sweep, I think has gone way, way up. First with the debate, and then somewhat ironically with the assassination attempt. So I think part of this is the market liking maybe the pro-business and less regulation that a Trump ticket might bring. But I think some of it is also just certainty. The market wants to know who's going to win, and they also absolutely want to avoid any type of sort of Bush-Gore type election where things get drawn out for a while.
As the Dow hit a new intraday record today, and you talk about the election, and obviously that is the element of uncertainty, it certainly seems that the wave has changed a little bit. And I do wish our president of the United States well with COVID, battling COVID, putting political views aside, and a more business-friendly administration, reportedly, right? That's what the Trump administration would be. Do you think that we'll be at a higher point at the end of the year? We're at 55.86 right now in the S&P.
Yeah, I think it's a good question. I mean, it's tough to bet against this market, and momentum has been the key and been the big driver. And I think the market is probably right about the election and right about the rate cuts, which is certainly propelling things forward. I do think there are some concerns out there that we've got to work through. One, I mentioned the seasonality. July tends to be a great month. August and September tend to be the worst months. I think the market is absolutely pricing in the soft landing. And those are never easy to pull off. And I think the Fed's going to have a challenge there, especially with the yield curve having now been inverted for 2+ years. We've seen a lot weaker economic data in the second quarter. Now that data's been better this week. We got good industrial production numbers. We got good retail sales. We got a good Philly Fed number this morning. So maybe that bottoming is in, but you really want to keep an eye on that market. And I think most especially on jobs. Jobs have weakened a little bit, but still been really, really resilient. It'll be important to watch claims going forward. It'll be important to watch that unemployment rate. The consumer spending will be tied to jobs. It's obviously been very robust through this whole run. So you really don't want to see that job picture deteriorate very much. And I think that's going to be the key to what goes forward. At this point, I'd say it's probably too close to call, but I would keep an eye on that economy, because if we start to lose that soft landing and recession signs start to show up, that will certainly take the market the other way. I think the last thing I would point to is earnings. 2Q, it looks good. Obviously, it's been a little bumpy in the first week or so, but I still think we're going to show good growth for 2Q, and most of this is going to be tech driven. But this is really going to be the last quarter that tech carries S&P earnings. S&P earnings are still projected up 10+% for 23, and a lot of that is in the back half, and a lot of that is expected to come from sectors outside of tech. And so I think we're going to have to keep a close eye on that and see how those play out.
Yeah. As I think about different sectors, there are some folks who think there's a big slump coming in the market, right? You talked about a soft landing and maybe being at a higher point at the end of the year, but there may be some sectors that may be safer than others. You're looking at REITs too. Where does that fit in to a portfolio?
Yeah, we really like the REITs here. We are listed real asset specialists, and certainly REITs is one of our big focuses. But we think REITs offer a good opportunity here. They were the worst performing sector in the first half of the year, and I think that was largely around fears around interest rates, and then also defaults on commercial real estate. But, I would make a couple points. First, fears around the REITs are really centered around sort of this urban office. And urban office is really a small piece of this overall index. Maybe it's 5% right now. And the fundamentals in a lot of the other sectors, subsectors, and I would point to stuff like, single family homes or, data centers, things like that. The fundamentals there are really good. So I would say, don't let your fear about office turn you totally away from REITs. REITs have historically performed very well once the Fed starts cutting. It seems pretty likely that that's going to happen in September, so we think that's good. REIT relative valuations are really attractive right now versus the broader market. And you've seen that have seen that confirmed pretty consistently over the last year or so through M&A takeouts within the REIT space. So we think that continues to happen. And then, I think REITs also bring really good diversification to a portfolio. I think, in a market like this that's so tech and momentum driven, people forget about the importance of that diversification. But we really think it's important to consider as you're building a broad portfolio. And then finally, REIT dividend yield 2x the market. Roughly 50% of the return from REITs is coming from dividend yields. And we think that's important, especially if you want to be a little bit more defensive or a little bit more worried about where the economy is headed.
David, great to see you. Thank you so much for all of that. David Grumhaus.